Good day, fellow investors. A question that every investor has to have answered is, how do I invest over the next decade? What kind of strategy? And the possible strategies are to be invested 100% all the time, what Peter Lynch used to do, to have a Warren Buffett strategy with 20% of your portfolio in available cash for opportunities, or to be even more conservative, more like Seth Klarman value investing, watching the risks, with 50% of your portfolio or more just sitting there in cash for opportunities. That's what I want to discuss because I'm exactly in that situation of thinking about what kind of strategy to apply next. Because this is my situation. Of course, you probably know that we have the YouTube demo education portfolio where we own a lot of stocks. I still have to add 5 or 10. We'll do over the coming months. And then there is different things here we follow for educational purposes, and we include those in the YouTube educational portfolio and check the sizing depending on the risk and reward. But this is YouTube. On my research platform, I have a similar diversified portfolio with now 17 stocks that I will push up to 20 or even more, where I look for good businesses with 10% returns or more. This is a still developing portfolio, but one portfolio that I've had there for 5 years almost now, and it is mostly 100% invested, and that works well. But now I have to start investing my money every month, and I will be putting 50% of my research platform revenues into that portfolio, and I have to decide what kind of strategy will I apply to this. And now let's immediately start with the pros of the always 100% invested strategy. As Peter Lynch says, you don't have to think about the market, you just focus on owning businesses and earnings, and then invest your money, and if it goes lower, reinvest the dividends, and you always try to buy the best thing out there. The cons are that you are not able to take much advantage of volatility except for the dividends or rebalancing, and the second con is that you own things no matter the price. And that has been the case with my model research platform portfolio, where it has been pretty much mostly invested, and now it is invested 100%. And I try to find businesses that have good fundamentals that offer 10% of higher returns, and that's exactly what the portfolio delivered over the last 4 years and 8 months. If I look at the performance, and I have rounded it up to 5 years, even if we aren't into 5 years and the contributions are 1,000 lower. So the performance, if things remain equal over the next 4 months till May for the full 5 years, is around 14% per year. So total contributions will be 20,000 and the portfolio is closer to 30,000 over the last 5 years. Good returns there in line with the strategy. The only problem is I cannot really take much advantage of the volatility. If something crashes because of market irrationalities or panic, I can reinvest the dividends or just rebalance. So that's the maximum there. But I can't have cash on the side to put there more. Then if we look at Buffett, he is somewhere in between. He has a lot of cash, but then again, it's not that easy. The pros are, yes, you can take advantage of the volatility. The cons are there is an opportunity cost, and there is always the question when to strike. There is the cost of cash. With inflation, it is getting less and less valuable, and with the market not really crashing, there is also the opportunity cost that you missed by not being invested. And then if you wait, there is always a question, will the market ever return below the point I'm waiting? So those who have been waiting since 2013 will likely never see such lows again. For those who want a more detailed academic view of this, you can check this video. We'll put the link in the description below, discussing how, yes, 70% is better to invest all the money, and in 30% of the cases, it is best to wait from a purely academical statistical point of view. Another question is when to strike. If we look at the S&P 500, Buffett had a lot of money here. He didn't strike here. Now that we have inflation, now he is buying significantly. And you can see here that during the great opportunity, his cash levels were pretty stable. And only in the last year has he gone from 160 billion to the current 123 billion. And the cash pile over the years just went up, but all of these were great investment opportunities that he didn't take advantage of. So the question is always when to strike. We have been discussing China here on the channel, and if you've been following it here, it was already a great buy, but then it went another 50% lower for an even better buy. So that is another question, and now it rebounded, but you can see here that it is still at the levels where it was just 10-12 months ago. So that's the issue. You can never predict the markets, you can never know what will happen. So it is a risk to take to sit in cash. That is definitely a truth. And let's say that you are fully invested and you invest in businesses that give you 14%, or you wait with cash or 50% in cash. And if you find an opportunity that will make 50% every 3 years, the results are equal. That is the balancing there. Or you invest in good fundamentals, no matter if you can find those, of course, or you simply wait for those jumps if you can catch them. But always keep in mind those bottoms can always go much lower. But as we said, this is equal, but can we get to 50% or even more often than every 3 years? That is the big question. Now you will say, Sven, this is timing the market, but I would say something different is timing markets or just stocks. If we look at a company like Google, it was 150, now it's 92. So that is a 33% decline, while the market is down just 20%. And even if we look at the volatility of the markets, you can see that very often it gives you interesting opportunities, especially from the points of high valuation where we are now. And when I say follow the markets or time the markets, look at this YouTube portfolio. You have China, you have the semiconductor cycle, you have the food cycle, you have the tech cycle, you have the oil cycle. So there are many markets that you can follow and then see when the opportunities arise in specific markets for better buys. So an answer to the question how much cash should one have depends on the current opportunities and on the scope of the market that you can follow, the research you can do, what gives you value from taking advantage of those specific market cyclical volatilities. Plus, a very important note there, more cash means less risk. Thus, if you make the same performance, but here you have much more cash compared to always fully invested, if you get to the same performance, you likely did it with less risk, which is then already a great thing. So let's now discuss my decision. I think I have structured it in an okay way. So the model portfolio and the demo portfolios here on YouTube and on my platform will be fully invested. And then I will try, as I follow a lot of things from commodities, iron ore, copper, this or that, food, countries, semis. I think that by following it and waiting for the right opportunities, I might get one opportunity a year to buy something that is oversold or in panic that will give me less risk for perhaps equal or even better returns. Of course, we cannot know the future, but let's test this and see in 5 years if it goes well. If equal in performance, that will also be a very good deal. And I'm a firm believer that in life you get what you focus on. So if I focus on those opportunities, I might even find them. Thanks for watching. Let me know what you think about the strategies and what applies to you. Don't forget to smash that like button.